Good morning. I'm Tim Nyland. Today we're going to have a little fun, and I'm going to illustrate for you the main benefit of inflation as it relates to corporate profits. Prior to Q3 earnings season this year, I mentioned several things I'd be looking for when companies report their most recent quarter. And the main item was trend confirmation and overall profit margin expansion that we've seen coming out of COVID. This week's webinar is going to be shorter, so be sure to stay through to the end. I'm going to show you some Zacks Research System charts that are going to shock you and discuss the risks as I see them. As a lead into this discussion, I'm going to show you that new F-350 truck I ordered back in August of this year. I'm going to do this because so many of you have sent me emails asking me if I really went out and bought a truck like I discussed in part 2 of the stagflation series. Well, I really did. And speaking of inflation, you're not going to believe how much I received in trade from my old 2019 F-350, so we're going to have some fun. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor tools and the Zacks Research System. Let's go ahead and get started. So as I mentioned, today's webinar is a follow-up to part 2 of the Stagflation Clues series, and I've gone ahead and circled that webinar in red if anybody wants to go see the original analysis. That particular webinar was an excellent webinar. I did a lot of macro strategy in the beginning of the webinar and at the end. So the actual discussion about purchasing a new truck and why actually took place around the 12-minute mark in that webinar, just so you're aware. So let's just do a quick revisit. Back on August 18th, I caught an article on the front page of Business and Finance in the Wall Street Journal that mentioned that Ford was shifting to custom ordering, and this was obviously due to the chip shortage. And so they were experimenting with this just-in-time sales model where they weren't going to really carry any inventories, just more or less support custom-ordered vehicles. And I thought this was really interesting. And then a follow-up article in the Wall Street Journal on that Friday, August 20th, Toyota also said that they're going to be slashing output as this semiconductor chip crisis intensifies. And so the very first thing I thought is that I need to probably go down to my local Ford dealer and inquire about buying a truck. And this is obviously from that previous webinar. I did what any portfolio manager would do, specifically Peter Lynch's model. And I went out and looked into this. So I went on the internet, I filled out all the information to purchase a brand new 2022 Super Duty F-350 Lariat loaded. Basically said in here that I wanted one as soon as possible. And within a day or two, I was at my local Ford dealer, and this is what I saw. And so there's obviously a problem here, and this problem exists to this day. So several months later, there are still no cars either in the used car parking lot or the new car parking lot. And this is obviously problematic. This is the new car lot. The previous slide, if I go back, was the used car lot. And all that's here is primarily just a few employee vehicles and not much in the way of new cars. Same thing with the display area inside and outside the showroom, simply no vehicles. It's that way to this day as well. And I round out a full 260-degree pan of the dealership. Behind this is obviously the service center, and still no new cars available, not even in the fleet area. Okay. So I went down to the Ford dealer, and literally it took 20 minutes and a zero deposit, right, to lock in pricing on a brand new 2022 truck from my local Ford dealer. So here's the order, and my salesperson obviously took good care of me, more of a customer service type representative at that point. Not much to sell. I pretty much walked in with my order, and the expectation that was set with me is that they did not know when my truck was going to be delivered. It was just sometime in 2022, and lo and behold, I ended up getting a call on the afternoon of October 28th, and my truck had arrived. And so what does that say about the chip shortage? What does that say about, Ford's priority on delivering vehicles relative to margins? I'm assuming these Super Duty trucks are higher margin vehicles for Ford. And, is the chip shortage really that bad for Ford? Not sure. When the expectation is set that you're not going to receive your vehicle until sometime in 2022, and then all of a sudden it appears on October 28th literally just a couple months after you order it, you have to wonder. So I was clearly caught off guard with this, and I wasn't necessarily prepared to sell my vehicle outright on my own, given the fact that I didn't want this thing sitting at the lot and it to be sold from out from underneath me. You'll see why I did this in just a minute. And so here's my old truck. Obviously, they look exactly the same. One's a 2019 with black interior. My 2022, virtually the same exact truck with more of a tan interior. I have two white dogs, and the black carpet and the black seats were a real problem. So this actually has the rubber floors in it, and I can literally just take a leaf blower and blow the dog hair out. That was the primary driver behind this. But the interesting thing is when we look at this concept of inflation and how this relates to the overall economy, this is the sales ticket for my 2019 F350 that I bought at the end of 2019. So I literally drove it for 2 years, put about 20,000 miles on it. I paid about $70,400 for it. You can see that here. Selling price, less rebates. I added some dealer accessories. It was $70,417. The interesting thing about this is that over the past several months, we've all seen the articles. This was actually just an article in the Wall Street Journal on Monday, November 15th. Again, I try to keep all this relevant for everyone. I thought this was great, right? Fed running out of excuses. The interesting thing here is that, the Federal Reserve running out of excuses for inflation. They were talking about, the highest inflation that has been, recorded to date, and it was, used cars and trucks. And you can see that the prices are up 24.4% since February of 2021. So the idea that I went in and locked in a new car price, back in August and kind of took advantage of some of the appreciation that my 2019 has gained in value. You'll see how this is paid off here in just a minute. So used car and truck prices were the highest increased category in terms of inflation. And if you're concerned about inflation and concerned about where inflation is headed, as I am, you're definitely not going to want to miss out on our next Lunch and Learn webinar this Friday, December 5th at noon Central Time. My colleague, Zacks Senior Relationship Manager, Meyer Thacker, is going to look at today's conditions compared with other infamous periods of rising prices as he poses the question, are we headed back to 1970 style inflation? Meyer will look what's similar and what's different between then and now, and what clues this comparison may offer about whether a higher cost of living is here to stay. Don't miss this session. It's this Friday at noon Central, and you can register for free at the link in the description below. So just literally open up the description below in this YouTube webinar, and you'll see a link in there. Go ahead and register for it. Meyer always does a good job with these webinars. So let's move on. Again, I'm concerned about inflation. Again, used car, truck, and car and truck prices up 24.4% at an annualized rate since February of 2021 this year. So when I went to purchase my new vehicle at Bell Ford here out in Phoenix, they actually ended up giving me a trade-in value of $74,500. Okay, plus a $2,000 factory rebate, and that was kind of unheard of. I think this is more of a Ford loyalty rebate, because certainly rebates at this point with this shortage is kind of unheard of. And so the idea is that I only paid $70,417 for the vehicle, and that was 2 years ago. Put 20,000 miles on it, and I literally just traded it in for $4,000 more than I paid for it. And I got a $2,000 factory rebate. So it's effectively a $6,000 gain towards the new vehicle, reset the mileage, get a 2-year newer vehicle. There's a lot of additional features that have been added to the 2022s. But the big thing is that I gained on this, and I didn't have to pay tax on the trade-in value. So it was almost, a one-for-one. I ended up saving well over $100 a month on the payment. And so, obviously one benefit for inflation here in this used car market. So anyway, enjoying the truck. Just want to let everybody know that I did go ahead and take possession of it. It's in the garage as we speak. But what I wanted to do at this point was have some real fun and dive into what's going on with corporate profit margins, because this is the real advantage of inflation. And everybody's, concerned about inflation. Inflation is actually a good thing to a certain point, and you're going to see that right now. And it's obviously not about me going in and trading in my vehicle and making $6,000 towards the purchase of a new vehicle. There's much more to this, obviously, than that. So we're going to talk about that right now. So as we open up the Zacks Research System, I've gone ahead and loaded up the symbol monitor with 4 different composites that I want to focus on today. And these are primarily the S&P 500 and the small cap 600. And we're going to take a look at the market cap bias versus the equal weight of each relative to what's going on at each level of margin. And we're going to talk about some of the risks, which is really the most important part of this webinar, what we need to be looking for. Okay, so we're going to start with a 10-year chart. I'm just doing a right mouse click history here. And the very first thing I want everybody to notice is, if you've seen my webinars, you'll know that this is one of my favorite views in the system. It's basically a 1-year % change in revenues in the top panel. And when you transform your revenue trailing 12-month series into a 1-year % change, you can actually see how the revenue input into the income statement is driving margin expansion or contraction down the income statement in terms of margins. So we can see this ramp up in revenue, okay? And you can see that gross margins are increasing a little bit, all right, which is good. At a minimum, we want these to stay flat. That would mean that our revenues are basically keeping pace with the increase in input costs. Remember, it's revenues minus cost of goods sold equals gross margins. But where the rubber really hits the road here for us is on this operating margin number, and that's your EBIT margin. And when I look at margins, and I want you to do this as well, I want you to kind of envision the income statement split between 2 sections, right? Above EBIT is everything related to operations, what we call recurring normal operations. Anything below EBIT is basically non-operating. So this is where your non-operating income, non-operating expense, interest expense, taxes, stuff like that. That's what takes place between operating margin and net margin, okay? So we know when we see these increases what's going on as far as operational efficiencies versus efficiencies coming in from non-operations. And that's the real advantage in being able to look at a chart like this, is you can dissect an income statement literally in seconds visually and give yourself a current relative to historical context as to what's going on. So is this a good thing, right? Is this a good thing that revenue growth is absolutely on fire? Absolutely, right? Is this a good thing that we've got gross margins actually expanding in this environment when we know that costs are rising for everyone? And the answer to that is yes. So we are in a 30-year unprecedented environment right now where we've got this inflationary environment, and we've got manufacturers and service providers actually able to increase their costs and outpace their own cost increase, right? So they're actually passing more increase along to customers than they're actually paying. So we've got this tremendous margin expansion literally happening at all levels of margin: gross margin, operating margin, and net margin, okay? And what I want everybody to see is when you go back through the history, you go from 10 to 15 years, right? That specifically, as this revenue growth has compounded year over year over year, remember, this is just a 1-year % change, right? So this is going to be obviously more of a mean reverting series than these gross margins are. I want you to see how much higher the market weighted average net margin, right? So it all boils down to net margin. Net margin obviously is what drives your EPS estimate revisions. We've discussed this in previous webinars. It all comes down to net margins. And I want you to see that net margins just over the last 15 years have almost doubled, right? This is tremendous, okay? And when we go back and we look at the 20-year chart, you can see that it does darn near double. And we can go back and even go to a 25-year chart and see that, yeah, it's pretty close to double, right? Actually, it's more than double, 7.94 to 19.14. Again, this is the market-weighted average company in the S&P 500. So over time, right, literally over the course of the last 25 years, what is this telling us, right? It's telling us that this compounding of this revenue growth in conjunction with this cost-cutting environment that U.S. corporations have been faced with literally over the last 30 years has led to operating margin efficiencies and net margin efficiencies that have more than doubled, almost tripled the efficiency of these companies to literally bring in $1 of revenue and translate it into earnings. So every dollar of revenue coming in, you're getting about 20 cents in earnings out of it. So the idea here is, what is the risk, right? Margin risks right now are clearly in the hands of two groups of people, right? It's the Federal Reserve and it's consumer spending and consumption confidence, that sort of thing. So the consumer spending side of this equation is easy to understand, right? The risk is that companies are no longer able to pass these cost increases along to customers, right? Consumers. And this causes revenue growth to roll over. All right. So what we're looking for, and this is really what I was trying to stress prior to Q3 earnings season when I said what I'm going to be looking for is confirmation in this margin expansion trend. And I'm going to bring the history back to, let's say, a 10-year chart just to give us better scaling. And you can kind of see where that Q3 number reported here. So we got confirmation of that revenue growth increase, and it was substantial. We also received confirmation that we're getting margin expansion out of gross margins. We got confirmation that, albeit operating margins are slowing down, the growth rate is slowing down just a touch in Q3, that, look, I mean, we're still getting expansion. This is tremendous. And the same thing with net margin, okay? So the risk is that companies are no longer able to pass these costs along to consumers, and this revenue starts to roll over. If that happens, right, you're going to see these margins begin to cascade. And this is a classic telltale business cycle rollover. I mean, this is what literally defines a business cycle. And the idea is that it can surely lead into a recession. And so the bigger risks are obviously from the Federal Reserve, right? So the other driver of obviously margin rollover would be the Federal Reserve underestimating the embeddedness of this inflation longer term and having to play catch up with rates, and overshooting the attempt to cool the economy and therefore triggering a recession, right? If that happens, we would see the same type of thing. So, we can watch yield spreads. We can watch, what's going on with ISM manufacturing and services, but we can also watch corporate profit margins to get a really good idea of what to expect out of the markets and out of the economy over the next 6 to 12 months, and that's what we're doing right now. The second main risk coming out of the Fed is an interesting one, right? This is the one where the Federal Reserve begins losing confidence in their own forecast of transitory. Remember that for the past, year and a half, the Fed's been pounding this drum that inflation's transitory. And right now the market is buying into it, right? I mean, if you look at spreads, you look at yields, you look at spreads, the market is buying into the fact that this thing is going to be more or less transitory. And we've had webinars where we've discussed that. But let's say that the Fed starts raising rates to cool an economy aggressively, where inflation does turn out to be transitory. So again, the Federal Reserve begins losing confidence in their own forecast of transitory. So they're thinking to themselves, wow, it's not really transitory anymore. They begin raising rates to cool an economy where inflation does in fact turn out to be transitory. And then the Federal Reserve is essentially throwing additional water on the flames of an economy that was already in the process of cooling, but they kind of missed it. And so this would also be pretty traumatic, because as the economy was already rolling over, if the Fed were to continue to raise rates, it would have a tendency to drive these margins down perhaps even faster. So those are the risks. There's primarily three of them from a macro perspective that we're watching. And so the takeaway here is that the Federal Reserve needs to get this just right to keep the economy rolling in this bull market intact. But what I want to show everybody at this point is what this looks like when we remove the cap bias, okay? And interestingly enough, the margin story actually gets a little bit stronger. You can see that gross margins are actually even higher now than pre-COVID levels, right? So the smaller companies within the S&P 500 are able to pass off even more cost increase in terms of revenue acceleration when we look at this gross margin expansion relative to where we were in 2019. And the interesting thing here is that it's the same picture, right? So small caps definitely benefiting. Notice the net margin is a little bit less for the smaller companies. So those larger mega cap type names are super profitable right? There's a reason they're mega caps. There's a reason why those valuations are a little bit steeper. Their net margins are ticking at about 19, 20. And for the S&P 500 equal weight, where we strip down the market cap bias, it's about 13.14. So again, equal weighted average company in the S&P 500. The thing that I'm looking at here that's super interesting is that these smaller companies are able to pass off cost increase in terms of revenues even more efficiently, perhaps, than the mega cap names, simply citing the fact that we've got higher levels of gross margins here than we did pre-COVID. And if I were to go back to the S&P 500, you'll see that that's not the case for the market-weighted S&P 500. So, at any rate, just a really, really quick observation I wanted to share with you. So let's go ahead and look at the small caps, right? So do we have confirmation from small caps? What we just witnessed from the SP5E, as a matter of fact, we do, right? You can see the revenue growth not quite as strong as what we see in the S&P 500, but we can see much stronger acceleration in gross margins and perhaps much stronger acceleration in operating margins and net margins, obviously, increasing as well. Not at the same levels, obviously, as your mega cap names, but this is obviously a great signal for those smaller cap names and is going to prove to be very bullish for that group. So this is why your small cap group, there's so much confidence in this group heading into 2022. If the Federal Reserve does a good job of threading the needle with the economy and the expectations for inflation, we can expect hopefully this to continue. At a minimum, what you want to see with margins is for them to flatline. All right, you don't want them to roll over. Okay, that's the key. And so when we compare the 6M to the 6E, right now we're kind of splitting hairs. We're actually taking the market cap bias out of the small caps, but it's important to do this exercise just to kind of see if there's some underlying trend that we need to be aware of. And you can see that we still have trend confirmation here coming in from Q3. It's pretty much the same. Okay, that's about it for this week. I hope I was able to give you some additional perspective on what is going on with corporate profit margins. And perhaps some of the risks associated with margins at these 30-plus year highs. Again, we're really in unprecedented territories, right? Companies have really not been in this type of position to pass off these types of cost increase in literally 30 years. So be sure to join me next week, and we're going to go ahead and expand upon today's webinar. And we're actually going to dive into each of the S&P 500 sectors and look at profit margins after the Q3 reporting season. You will see next week that not all sectors are created equal. So if you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you for watching, and I'll talk to you next week.